let's take a look at the third question from the Chapter 18 quiz. Zao Inc. reports the following pre-tax income or losses for both financial reporting purposes and tax purposes. So we're told the accounting income and the tax rate for 2018, 2019, and then you'll see that in 2020, there was a loss of 150,000. And then in 2021, there's income of 120,000. And it says the tax rates listed were all enacted by the beginning of 2018. Zao reports under the ASPE future income taxes method and uses a valuation allowance to account for future tax assets. So we do need to remember that we're using ASPE here so that when we're naming the accounts in our journal entries, we're thinking about the fact that ASPE calls deferred tax assets future income taxes, and the terminology is slightly different. We're also told that they use a valuation account, so that's important information and only allowed under ASPE. So the first thing we're asked to do is assume that it is more likely than not that 20% of the carry forward benefits will not be realized. Prepare the journal entries for 2020 and 2021. Okay, so what are we going to do here? Okay, so we have an income tax loss in 2020 of 150,000. So we need to figure out what Zao is going to carry back versus what their carry forward will be, because the journal entries are different depending on whether it's a carry back or a carry forward. So let's start by making a schedule of what's going to happen with these losses. So we know in terms of carrying back or carrying forward. So we've got 2018, let me just fix the formatting here, 2018, and so we've got 2018 and 2020. Oh, sorry, 2018, 2019. So we've got amounts that we can carry back. So the accounting income or the taxable income, which we're told is the same for simplicity, is these amounts here. So we've got 20,000 and 50,000 of accounting income. So this is the taxable income, because the taxable income and accounting income is the same. And we need to know the tax rate in each of these years. So we've got 25% in 2018 and 28% in 2019. So what we need to do is calculate what our tax is that we can carry back, because that's just the accounting income. It's not what we can carry back. What we can carry back is the taxable income times the tax rate. So we're going to multiply these through to see what we've got there. And then let's just run a total. So that's the most that we can carry back. This is our maximum carry back. We could carry it back 3 years, but we've only got 2 years in the question. So that's the data we're working with, because it says that I believe it says they just started operations. I'm not sure if it says, but that's the data that we have to work with. So if we look here, we can see that we've got a carry back. Let's see if we can make a line there. Okay, so we've got our total here. So we've got taxable income. These are the 2 years here, 2018, 2019. That's what we can carry back, $70,000 of taxable income. Once we multiply that by the tax rate, we can get $19,000 of a carryback. So that's going to use, so we still have an amount left. So we still have, so the carry forward is going to be 150,000 because that's our loss, minus what we've carried back. So we have an $80,000 carry forward of taxable income that we can offset in the future. And it says that there's no change expected to the tax rates, I believe. Or 30, I guess we'll use 30%, which is our future tax rate here. So then what's our actual carryback? It's going to be 24,000. So that's our carry forward. So we're carrying back the maximum amount of the loss, and then we're also carrying forward the remainder. And then we can make, and then we're also told in the question, remember in A, it says, assume it is more likely than not that 20% of the carry forward will not be realized. So 20% of carry forward is going to be this amount times 20%. Did I do that right? No, sorry, this amount, the benefit. So it's the 24,000, the actual tax carry forward times 20% is we're assuming that 20% of this amount will not be realized. So we're going to need an allowance for 4,800. So now we can get started with our journal entries now that we know what's going on. So we're talking about 2020 first of all. So we're doing December 31st, 2020 journal entries. So the first journal entry that we're going to have is to reflect the carryback of tax losses. And so our entry is going to be debit, income tax receivable, because we actually can get a check from the government for this amount. And we're going to have this amount here, 19,000. So this is going to be 19,000. And then we're going to have credit, current tax benefit. With tax accounts, just for illustration, I like to show what's going to go through the income statement and what's going to go through the balance sheet. This is ASPE, so I'm putting balance sheet here, and this is going to be 19,000. So basically, we're going to have a reduction to our income tax expense on the income statement, and we're also going to be setting up an income tax receivable on our balance sheet. So that's the carryback. Now we need to record the carry forward. So for the carry forward, our journal entry is going to be debit, future tax asset. And this is the terminology in ASPE for a deferred tax asset is future tax asset in ASPE, or in IFRS, we would call it a deferred tax asset. In ASPE, we call it a future tax asset. And this is going to be this amount. And then our credit is going to be to future tax benefit. And this is P&L. So you can see that through our income statement, we're recognizing both the carryback and the carry forward. And then on our balance sheet, we have set up an income tax receivable, and we've also set up a future tax asset. And there's one more thing we need to do, and let's not forget about that, is we need to recognize this allowance. So remember how in the question it said, assume 20% of the income tax, the carry forward benefits will not be realized. And we calculated that amount right here, which is just 20% of the 4,800. So we need to put an allowance here. So ASPE allows us to have an allowance, which means we don't hit the future income tax or the future tax asset on our statement of financial position directly. We don't hit the future tax benefit, the P&L. So we're actually setting up two separate accounts, almost like an accumulated amortization account, how you're not hitting the asset. And that's the same idea with this allowance for the 20% of carry forward not realized is we're going to set it up in an allowance account. And we don't know if it's going to be realized or not, but that's the assumption, is that we don't know if we're going to have taxable income that we can use to offset those tax losses. So our entry is going to be debit, future tax benefit, P&L. So you can see we're hitting the P&L account directly. These two accounts are the same. And this is going to be important when we talk about the income statement presentation later. You can see this account and this account are the same, but we're not going to hit the balance sheet account directly. Just like with accumulated amortization, we don't hit the asset directly. And this is going to be our allowance, which is going to be this 4,800. And our credit is going to be allowance to reduce carry forward to net realizable value. And that's going to be 4,800 as well. And that completes all of our journal entries for 2020. Okay, so now next in the question, so we're asked to do quite a bit in part A. It doesn't look like a lot, but it is quite a bit. Now we're asked to do the journal entries for 2021. Now, what's going to happen in 2021? Well, in 2021, we're going to make $120,000. So now we can use up our some of our carry forward benefit. And so we need to recognize what's going to happen now when we actually do make positive income in the future. So December 31st, 2021 journal entries. Income of 150K is going to be, so what are we going to recognize first? So we need to recognize our current tax expense on this 120K. Actually, I put 150. We only made 120, but still, we still have 120K of income. Okay, so we're going to have current tax expense. And we're going to have income tax payable. So let's record those entries. So to figure out what our current tax expense is, let's figure out how much of our loss carry forward we can use. So we've got taxable income before the loss carry forward is going to be 120,000, right? Because that's what we made in 2021. Then we've got our tax loss carry forward. We're talking in gross dollars here. So this carry forward, if we go up here, is going to be $80,000. Remember the schedule that we had made? $80,000. So the revised taxable income after offsetting the loss is going to be 120 minus 80. So we have 40,000. And then our tax rate is going to be 30%. So what's our current tax expense going to be? Is going to be, fix this, current tax expense going to be 40,000 times 30%, which is going to give me 12,000. Okay, so to figure out our current income tax, we've got the current taxable income before the loss carry forward. So we made 120,000 in 2021. We've got a tax loss carry forward of $80,000, which is coming from up here. And this is gross of the allowance. And then we've got, so now we have revised taxable income, which is simply the difference between those. 40,000, we're going to apply the tax rate of 30%. And our current tax expense now is $12,000. So our journal entry to record that is going to be debit, current tax expense. Just ignore my spelling there, 12,000. And this is going to be credit, income tax payable. So this is our regular current tax expense entry that we would record for current income taxes. The next entry that we need to do is to record the using up of the carry forward benefit. Because we applied the entire carry forward benefit right here in our calculation, we took advantage of everything we had to carry forward. We didn't change what we had carried back because we've already filed an income tax refund. If we go up to the top, we already filed an income tax refund for what we carried backwards. But what we carried forward here, we've used up now. And previously we had recorded and future tax asset related to that carry forward benefit. We don't have that benefit anymore because we've applied it against 2021's income. So we need to record the using up of that asset. So if we look at the entry that we originally recorded, we recorded debit future tax asset, credit future tax benefit. And so we're essentially going to reverse that, but instead of calling it benefit, we're just going to call it future tax expense just to show it's going the other way. So we're going to have debit future tax expense, credit future tax asset. So we're just removing the asset from our balance sheet here. So again, this is P&L, and this is balance sheet. Okay, so we're just simply taking the 24,000 off. Now, arguably, we haven't used up the we did use up the entire 24,000 because we applied this 80% against it, or the whole 80,000 against our taxable income. So we used up our entire carry forward benefit. And next we're going to remove the allowance, because clearly we don't need an allowance if we don't have a carry forward benefit anymore. And so if we look up at the allowance entry that we had originally recorded to account for the fact that in 2020, we weren't sure if we would generate future taxable income, we recorded debit future tax benefit and credit allowance. So we're simply reversing that entry. So we're going to debit the allowance and credit future tax expense. We're just getting rid of the exact amount that we had put there. We're just clearing out our balance sheet. I'm really bad at spelling expense. Okay, so this is P&L, and the first one is obviously balance sheet. And there you go. Those are our journal entries. So now we've gotten all the way through December 30. We've recognized the loss and the carry back and the carry forward of those losses in 2020. And now we've recognized what's going to happen in 2021 when we do achieve taxable income, how we're going to recognize the using up of the carry forward benefits. So we did A. So B says, based on your entries in Part B, prepare the income tax section of the 2020 and 2021 income statements, beginning with the line income or loss before income tax. Okay, so B is going to be the P&L section for taxes for 2020 and 2021. So it's really important that we remember what periods we're talking about here. It's not surprising we're in 2020 and 2021, but at the same time, we just want to make sure we know exactly what we're being asked to do. So let's go 2020, operating loss before income taxes. So remember, we had a loss here of 150,000. Right? And then now we're going to have our income tax benefit section. So we've got two pieces to remember. So remember, in 2020 is when we had our loss. So we're going to have two benefits to record. So we've got the current benefit due to loss carryback. And then we've got the future benefit due to loss carry forward. And I'm just going to expand these out a little bit so we have some room. We're going to put our numbers in there. So we're going to say, okay, so what was our loss carryback that we had? So we had, this is our carryback. So we had 19,000 there, balance sheet. So, oh, sorry, P&L. So let's pick up our P&L account. So we had 19,000. And then what was our future benefit due to the loss carry forward? Our loss carry forward was worth 24,000, right? But on our income statement, we're going to show it net of the allowance. So we also have this allowance here. So we have a credit on our income statement. It's a benefit, so it's a reduction of our loss, but we have to reduce it by the allowance. So it's shown net on the balance sheet. And there you go. And then now we are going to have, so our total taxes then is going to be the sum of these two things. And again, these are both benefits. So they're not expenses, they're benefits. So they're going to reduce our loss because we're carrying back some of it, we're carrying forward some of it. So we're recognizing the benefit of that in the year of loss. So see how our net loss was 150? Once I add 38,200, now my loss is only 111. So the loss decreased. So let's do the same thing for 2021. So we're going to have operating income before income tax. So remember, we made money in 2021. We made 120,000. Okay, and then now we're going to have our income tax. These are income tax expenses now because we have operating income. We just call it income tax, but they are expenses. So then we've got our current tax expense. We've got our future tax expense, which in IFRS we would call our deferred tax. So here we had, what was our current tax expense? We had 12,000. This was our income statement number here. And what was our future tax expense? Our future tax expense is, well, we cleared that out. So we need to record the expensing of this future tax expense, because see how we put it through here as this 24 and this 24,000, and we cleared out the allowance as well. So we need to show the net of those two things now showing as an expense. So this is us putting it on as a positive, and this is us taking it off as a negative because we used it up. And then our net income. So our total taxes here are going to be the 12,000 plus the 19,200. So our net income is going to be 120 minus that. So see how this is an expense now. So it's decreasing our income. So now our net income is 88,800. Okay. So C says, indicate how the future tax asset account will be reported on the December 31st, 2020 and 2021 balance sheets. So under ASPE, so C, going to be balance sheet presentation. So we're going to have, say, 2020 and 2021. So we're going to have here, we're going to have current assets, future tax asset, and we would have reported the entire 24,000 that we had in our books as a current tax asset in 2020 and nothing in 2021 because of course we've cleared it out. And then we also need to show less allowance to reduce to net realizable value. So then we're going to show this 4,800 here. Nothing here, of course. So then I'm going to show my future tax asset. And then that would be the sum of these two things. That's what my balance sheet would look like. So I would show the allowance separately from the future tax asset so that the reader of the financials can understand that the future tax asset is actually 24,000 when I'm carrying forward, but that I do have an allowance against it. And the last piece of this question, which is D, it says repeat part C, assuming Zao Inc. follows IFRS. Well, part C, so let's put D. IFRS requires all future income tax to be classified as non-current. So it would be non-current. And doesn't allow the use of valuation accounts. So if we were reporting under IFRS, we would have just hit the future tax asset, which we would have called the deferred tax directly. So we wouldn't have this allowance account, but we would have deferred tax of 19,200. So we would still reduce the amount. We just wouldn't set up the allowance, and we wouldn't have called this current. We would have called it non-current. That would be the difference under IFRS. And that takes us through the third question on the quiz.